And then we're going to go live here on Instagram. Checking. Okay, yeah. Awesome. So we are here live with the Dahlia Group on Facebook, Instagram, all the things. Hello, everybody. We are here with Angie with Ideal Mortgage. If I say this not right, let me know. So we're going to go over a couple of things. I'm going to let Angie take the reins, and we're just going to go through a couple of things here in our lender series. So what are we going over today?
We're going to talk a little bit about down payment versus closing costs. We'll start there first. There's a lot of misconception, a lot of confusion when it comes to that. So we can start there.
Yeah. Okay. So what's the difference? What's the major difference between down payment and closing costs?
So down payment and closing cost. Down payment is what is required depending on the loan that you qualify for or the loan that you choose.
Yep.
Some borrowers have many options, many loan options. They could do 3, 5, 10, 15, 20% down. Other borrowers just have one because they only qualify for that. So that's down payment. It's in accordance to the loan which you qualify for or the loan that you choose. And then your closing cost is totally separate. It's basically what it costs to do the loan, what it costs for you to buy the house.
Right. And Angie said people can relate to purchasing a vehicle, right? So when you purchase the vehicle, $1,000, if you sell your car for $1,000, it costs money to transfer that title over, right? So that's it's the same concept. So it costs money to purchase. So what are the things that are broken down in the closing costs? What are some of those?
So you're going to have your loan costs, what it costs to do the loan, to actually do the loan. You're going to have your appraisal fees. You're going to have your title fees because you have to go through title.
Yeah.
You have to take care of the deed. You have to take care of all that fun legal stuff.
Sure.
And then you're going to have your prepaid items. So you're going to prepay your homeowner's insurance or your flood insurance.
Right.
You're going to reimburse the seller for any taxes which the seller already paid. And that can get very confusing sometimes.
Well, the calculation is pretty confusing, right? So you take the amount of taxes by 12 months and then figure out a daily cost, which is all something a computer system does, and a human, like the human being that's able to actually calculate that stuff out, able to do. So that's something that they do. If you want those actual calculations, we can get those to you and show you what that breakdown is, but it is a computer system that would come up with those numbers.
Yep. And in our cost sheets, in our sample cost sheets, we're just going to basically dummy it down. You're going to see that our prorations are going to be high, just so that there's no surprises. That settlement, those numbers do get adjusted. Everything that you pay up front, if you have a home inspection, is going to be included in that cost sheet. If you have you will have appraisal, it'll be included in that cost sheet. All those numbers are all compiled in one and added together, and you're going to see this huge number that may scare you. But that's how we come up with everything.
Right. Yeah. And the appraisal, the homeowner's insurance, all of those things are estimates.
Correct.
Right. So title insurance. So all of those things, we won't know the actual cost. So we kind of make it a little bit higher. So that way, again, right, you're not shocked at the end of the day when you're like, you actually have to come up with a little bit more money. We would rather you have to come up with it.
You're happy.
I mean, who isn't happy when you do that? Absolutely.
You're happy that our numbers were high and ultimately you didn't have to bring as much to closing.
Right.
We try to add as much in there as possible, even appraisal reinspection fees in case something comes up with an appraisal, and now the appraiser has to go back out to the property and re-inspect for that railing or for the lead-based paint. Every time that third party goes out, they are going to charge you. So we want to make sure we include it. And hey, if at the end of the day it wasn't needed, then it comes off those numbers, and ultimately your check that you're writing will be much lower than you anticipated.
Yeah, which is always a nice thing. So you were saying a little bit earlier about the down payment being specific to a loan type. Can you go over that just a little bit? So you're saying FHA, you have to have what down?
FHA is a minimum of 3.5% down.
Okay.
You can do higher if you wish, but a minimum of 3.5%.
So if you don't have that, right?
Correct.
Then that's unfortunately a loan type that you're not going to qualify for, right?
Correct.
Is that what you're saying?
And it's also score dependent. some borrowers
Right.
only qualify for an FHA loan because their scores are not high enough to go conventional or USDA. So for those reasons, you know, we have those borrowers who they have all
Sorry,
the
yes.
options, and then we have those borrowers who only have one or two options.
Right.
So, yeah.
Yeah, so keep that in mind when you're going through all of this. And this is why you guys to really talk about money and finance and what do you have to put down, what's going on in your bank account, what's going on in your life that you would be able to make small changes to maybe build that money up so that you do qualify for a different type of loan or the program that best suits you and your family situation or your situation generally.
Correct, and ultimately it's informing you of, I know it can get a little complicated, but it's informing you. Our job is to inform you, make sure you're educated in all these programs, that we give you the option of possibly, if you don't qualify for one of those programs, possibly qualifying for them. We'll set up a plan, and you know, if you feel like you need to put 10% down, that's totally up to you.
Right.
If you feel you need to put less or more, again, that's totally up to you. Your options are given to you, and then you take it from there.
Right. It's honestly your decision and how you want to proceed.
Your money.
It's your life. It's the next 30 years, maybe, hopefully less, but the next 30 years of your life that you're able to do these things. So, all right. So closing costs, down payment. We know the difference. So down payment is what we're putting down on the house to what we qualify for, what type of loan qualify for. Closing costs are going to be those costs that the costs in order to purchase the home.
That additional piece.
So the additional money. And when you ask for seller assist, where is it going?
It's typically going towards your closing costs. And again, that's where we come up with that vehicle. You know, and you could talk to them about a little bit more about negotiations and so forth. But that's where it comes up. The vehicle example comes up. Ultimately, when you purchase something, it's your responsibility because you're purchasing.
Oh, poor connection on Instagram. Sorry, guys.
Yeah.
My gosh. All right.
It's your responsibility as the buyer to pay those costs. So when you're asking for seller assist, it's negotiable. You can reduce some of those closing costs, but again, it's not guaranteed. So in our cost sheets, you know, keep in mind if you ever ask to put a number down, it doesn't guarantee that it's going to get accepted. Not from our end. Until you have things in writing, guys, it's pretty much an estimate of what could happen.
Yeah, absolutely. Yeah. So, and going back to like homeowners insurance, right? So every company is going to give you a different amount. Title insurance, every title company is going to be a little bit different. What else? Like all of those things can be adjusted. If we go to settlement and we say we're going to close on the 15th and then we end up closing on the 30th, your taxes are going to be a little bit different, right? It's a daily proration. So all of those numbers until the day we go to close are kind of up in the air, but we get them as soon as we possibly can. We bundle everything up. We make sure everything is kind of solid as soon as possible, so that way you have the most accurate number. But it is, if you wait until a couple days before to get homeowners insurance, and we don't have that solid number yet, that can be, all up in the air.
We're gonna put a number in there for you, and it's just, for example, $840 a year. It depends who you shop for. Some companies like to get you, and their rates are up there, and others give you good quotes. You know, I have borrowers who pay in the 500s for homeowners insurance, and I have borrowers who pay double that. Flood insurance is another biggie.
Ooh, flood insurance is a biggie. I had someone just quoted, I think it was like $2,600 a year for flood insurance or something like that. So it can be a lot, right? It's a lot of research. It's a lot of knowing what you're doing. We all have those brokerages, the insurance brokerages that we use, and we can recommend if that's something that anyone is interested in doing. As always, we always have a list. So let us know if you have any questions about the difference between down payment and closing costs. And what are we going over next?
So let's talk a little bit about points.
Oh boy, that's a big thing right now,
Yes,
right?
it wasn't as common before because rates were so low.
Right.
Now it's becoming more and more common. So to sum it up, points is basically the ability to buy down your rate.
Right.
That's an option that's going to be very different for every borrower because it's credit score dependent,
Yep.
it's loan dependent, down payment dependent, so your
Yep.
loan amount, and it fluctuates with the market.
Right.
It depends what the market looks like
Right.
today. So just like rates, just when you come to us and we're talking about interest rates or we're talking about points, until we really look at your credit, until
Right.
we really are able to tell you, okay, you chose a 20% down loan or
Right.
a 3% down loan for 300,000 or 150,000. Until
Right.
we get into those details,
Right.
it's going to be very difficult for anyone, for
Right.
any lender, to really tell you this is what it's going to cost. And you can't compare yourself to your neighbor, to your brother, to your sister for as much as you would like to.
Yeah.
Everybody's different.
And today is different than tomorrow,
Yes.
and the next day, and the next day, and someone that bought that 15 years ago when points wasn't a thing.
Yeah.
People even then, like, people weren't really buying points down. I think that because we had this like lull in interest rates, people realize that they can get it down a little bit further, so they're more interested in. And I think points became a really big topic of conversation. But it is, so what are you, tell us, when you buy a rate down, what are you doing? What does that mean?
So
Like, where's that money going?
So the money is going towards purchasing that rate,
Okay.
towards lowering that rate. It's not worth it for everybody. The cost is going to be different for each
Right.
borrower. So by lowering that rate, your monthly payment becomes lower.
Right.
For borrower A, if borrower A, the cost in points is $1,200, and it lowers their payment by $100, borrower B, the cost in points can be triple that.
Right.
Could be $3,000-$4,000.
Yep.
And only lower their payment by $50. $50.
Yeah.
So is it worth it? That's a conversation that we really need to go into detail for you personally,
Right.
so that you can analyze, is it worth it for me?
Right.
Is it worth it giving this money up front? And if I give this money up front, how quickly will I make that money back?
Right.
If it only costs me $1,200
Right.
or $2,000,
Right.
and
And it saves you $100 a month.
you're gonna make that up in less than
It's-
2 years.
Exactly.
1
So
to
does
2
that
years.
make sense for you in your situation? And not only that, but do you have the $1,200 right now? Because it is a cost
It's
at time
additional.
of closing. So it is something that does make sense for some people, and that's where a good lender comes into play, that can kind of give you that side by side. When you figure out the house, when you figure out the day you're putting the offer in, when you figure out your down payment, when you figure out what your closing costs are, when you sit down and have that conversation with them and say, okay, well, you know what, I have, $2,500 extra that I was anticipating putting towards this, what can I do? And that's the conversation. Like, okay, well, here's the amortization schedule and schedule. Never. Who can say that? No one can say it.
I can't.
Here's the life of the loan, and these are the payments, and this is what it looks like, and then this is what it looks like with
Correct.
maybe buying your rate down a little bit. You can also do those amortization schedules. Got it. Online, which are really vague, and I don't know that I 100% recommend it for everybody, but it is something you can do to kind of figure out if that rate buy down makes sense for you. And again, right, that's the question.
Yep.
How fast are you making that money back? Right?
We personally, we like to see that the borrower ideally makes that money back within 3 years.
Right. Okay.
Anything between 3 and 5, let's analyze how long are you really going to live in there, because if you're only planning on living in that property for
It's my
3
favorite.
years, 4 years, is it really worth it?
So average, and this might be a little bit dated, but I remember last year in Lancaster, average lifespan of someone living in a home was 7 years. So think about that. 7 years, if you're living in that home and at 5 years you're not really even making that money back,
Yep.
You know, it's just a conversation. It's a conversation to have. I mean, when interest rates 8%, maybe it's worth it, but you need to figure that out.
Correct. If you have excellent credit, really good credit, yeah, I think definitely it's worth a conversation.
Sure.
As the credit score becomes lower or is lower, you become more risk to the to the lender.
Yeah.
Therefore, everything becomes more pricey. So, and that again, that's with everything, with points, with interest rate, with everything.
Yeah, absolutely. So we go over points and down payment and closing costs and the difference between the two. Is that what we're going over? That's we're wrapping up.
Yep, we're keeping it clean, simple.
This is awesome. I like this one. This makes me happy. So points are important. Understanding the difference between closing costs and down payment is super important. If you do have any questions, you can always reach out to us. The Dahlia Group has our info at thedahlgroup.net. We have our phone number that you can actually call or text 717-333-7045. I think I got it this time. Last time I was like, I don't know. I might be wrong. I'm almost positive that is the correct number, guys. We have that all in our bios. You can reach out to Angie. Do you want to plug in your phone number here?
717-449-0823. I know that one.
You're like, I got this. There's so many numbers and things going on in this brain today that I'm like, I can't do it today. But yeah, as always, guys, if you have any questions, if there's anything that you want to see, please reach out to us. Let us know what's going on. If you have any specific questions, we have experts by our sides that's going to be able to answer those questions when it comes to lending and how they do things and what they look at and why they look at it the way they do, and if those point purchases make sense for you. As always, let us know. Thanks so much for hanging out with us, and have a fantastic day. Bye. I'm going to get off of this one first, and then this one now. All right.